Hi everyone, welcome to another webinar from Zerodha. This one is about goal-based investing, and to help us with that, I have Mr. Aashish Somaiyaa with me. He's the CEO of Motilal Oswal AMC. He brings with him rich and varied experience with more than 17 years in sales and distribution, channel management, product development, and institutional sales from ICICI Prudential AMC, and a brief stint at project management with Bharti AXA Investment Managers. His last assignment was with ICICI Prudential as Senior VP and Head Retail Business, where he was responsible for sales, distribution, product development of mutual funds, PMS, real estate, and a lot more. Mr. Somaiya holds a Bachelor of Engineering in Polymer Science and a Master in Management Studies in Finance from NMIMS Mumbai. As the CEO of Motilal Oswal AMC, Ashish is responsible for strategizing and growing the operations of the business as a niche focused expert equity boutique based on its unique and time tested buy right, sit tight investment style. Over to you, Ashish.
Hi, thank you very much. Good afternoon, everyone. It's a pleasure for me to be here. Thank you for inviting me, and I look forward to some fruitful interactions. The topic for the day is about building a goal-oriented portfolio of mutual funds. Um, and I think that for our young, digitally savvy audience, I think this is an extremely relevant topic. I hope to do justice to the topic which has been decided upon. So I think how we'll take it is that for the first few minutes, I'm going to share my experiences and my thoughts relevant for this topic. If I was to build my own portfolio, uh, I'm not as young now, but if I were to actually be in the shoes of a youngster, say maybe 25 years old, and if I had to build my investment portfolio with certain long-term goals in mind, then how would I go about approaching it? So I'm going to share some of my experiences and my thoughts, and then of course I'm most happy to take questions if there are any. So coming to the topic, building a goal-oriented mutual fund portfolio. Now, most importantly, the operative word here is goal-oriented, and we've just seen a fabulous, probably amongst the best World Cups that was ever played. And from that perspective, I think anything to do with the word goal should be hopefully top of your mind. But how does the word goal, as applied to the world of financial planning and investing, how does the word goal actually fit in? It's very important to keep in mind that whatever we are saving or investing, what is the basic purpose? Why does anybody have to save, or why does anybody have to invest? And for that matter, what is the difference between saving and investing? So, if you think of visual objects, if you think of this visually, whenever somebody uses the word save, what kind of visual representation comes to your mind? Whenever there is a saving product, my fraternity, we advertise quite a bit. Whenever there is somebody who advertises a product which is about saving, then what kind of visual representation do they make? And whenever somebody advertises a product which is about investing, then what kind of visual representation do they actually make? Now, if you jog your memory, what you will realize is that whenever somebody's talking about saving, they show basically a piggy bank, and they show a hand which is actually putting probably a 1 rupee or 5 rupee coin into the piggy bank. So the idea of saving visually relates to stuff like piggy bank, or your saving account, and people keep collecting some money in the piggy bank. And why they show a piggy is because it's basically the money goes into the piggy's tummy, and he's supposed to keep it safe and secure. And one fine day when you want it, he's willing to give it back to you. But the connotation of saving is more, of course, saving, protection, keeping things as they are, and whenever you want it, maybe you can access it. Now think of investing. What kind of visual representations do people present to you when they're talking about an investment product? Usually, investment products are shown with a pictorial representation of a small sapling becoming a plant and the plant eventually going on to becoming a huge tree. So the connotations are totally different. Saving are more about preserving your money, keeping it safe, keeping it as it is, and investing is all about growing. That brings me back to our topic, which is about goal oriented investing. So, the first thing about investing is that it's aimed towards growing your money. And in our world, there is a bit of a challenge because unless and until you are a chartered accountant or a management graduate, somebody who studied finance, you don't end up really learning a lot in your school days, in your college days. You don't really end up learning a lot about how to manage your money. We spend a lot of time in trying to understand how to earn our money, but I don't think we do enough in terms of understanding how to manage our money and making sure that our money works towards creating more money for our future. So it's important to invest, and at the same time, it's very important not to confuse investing with saving. A lot of times, these saving products, when you put your money into the bank, they give you a rate of interest. You put your money into a deposit, again, it has a rate of interest. Your saving account has a rate of interest. Always keep in mind that anything which fetches you interest, basically, the other word for interest is rent. In the olden days, there was no word called interest. When there was Adam Smith and when economics was just being invented, at that point in time, the word which was used was actually rent. And interest is basically a rent paid for using money. So interest is actually meant to, at best, compensate you for inflation. And anything which pays you interest can keep your money safe. At best, it can compensate you for inflation. But look at it this way, that if interest rate is going to compensate you for inflation, then at best, what is going to happen is that your purchasing power remains the same. So let us say you put 100 rupees in a deposit, and at the end of 1 year, the 100 becomes 107, and inflation itself is 6 to 7%. Then what you are buying today for 100 rupees, the same thing you will be able to buy next year for 106 or 107. So the point I'm trying to make is that never confuse investing with saving. Savings products pay you interest. Interest is a compensation for inflation. And when you are saving, which you actually sometimes think is investing, when you are saving, at best, you will be able to keep your purchasing power where it is. At best, you will be able to preserve your purchasing power. Investing is not about preserving purchasing power. Investing is about enhancing your purchasing power. So let us say you invest 100 rupees today and you make an investment in a way, make a long-term investment in a way that over a number of years, the 100 becomes 110 or 120 or 130. Then clearly you are not only going to maintain purchasing power, but you are going to increase your purchasing power. So investing is all about increasing purchasing power. Investing is not about beating inflation. Investing is not even just about preserving purchasing power. Investing is all about making sure that your money creates more money for you. Investing is about enhancing your purchasing power. Investing is about changing life outcomes. And investing is about enhancing your standard of living. So investing has to be oriented towards growth. That is something which is extremely important. And now come down to what kind of assets, what actually helps you to enhance your growth. I think the only asset class which really helps you to grow your money and helps you to produce more money from your money is actually equities. And that is what my day job is. That is what I do for a living, which is to help people manage their money in equities. Why did I say that equity is probably the only asset class which helps you to enhance or which helps you to grow your money? Because when we are buying equities, we are buying shares of companies, and the shares of companies, I'm not going to get into technicals, but shares of companies actually derive their value from the earnings of those companies. Now, I'm sure a lot of you work for companies. You are yourself involved in or engaged in activities which result in profits for your companies. And any successful company, any high quality company is usually a growth oriented company. All of us work for a corporate sector. All of us work for corporate sector. Most of us actually work for corporate sector. Some of us are actually quite blessed to have our own businesses. And I think whether it's our own business or whether we work for a corporate, typically what happens is that we would like to see our business growing year on year. We would like to see our profits growing year and year. That's the reason why, if we work with our bosses or promoters or founders, this is the reason why the board of a company expects the people who are running the business or contributing to the business should be able to grow it. Because growing is important. Growing is a way of life. And by nature, companies are basically living beings. They are staffed by intelligent people like yourselves. And all these people contribute towards growth. Have you ever come across a company which says that I do not want to grow, or I do not want to serve a larger market, or I do not want to enhance my profitability, or I do not want to enhance the services that I provide to consumers? So typically, equity is an asset class which derives its earnings from the profitability of companies. And successful companies, high quality companies, are usually growth oriented. So equity is an asset class. If you're a co-owner or a part owner of a company, that's what equity as an asset class represents. Then it has the ability or the potential to grow your money. Now, coming to where does all of this fit into goal orientation? Look at it this way. It's very simple. Let us say that you are in the early stages of your career. Let us say you are 25 years of age, 28, 30, maybe 32. And let us say that you think one of your goals in life, I mean, the first and most important thing that all of us need to do is we need to be able to put pen to paper, and we need to actually put down in writing that what exactly appeals to us. What is it that we are looking forward to? For instance, anybody in the late 20s or maybe the mid 20s or even maybe early 30s nowadays, one of their important goals might be to start a family, to get married, maybe to have a child, but eventually it's about starting a family. And there are a few things which go with starting a family. So eventually you might want to buy your own house. So let's look at it this way. At the age of 25, if you think that by the age of 35, you visualize yourself to be at a certain life stage, and by the age of 35, you don't want to be living with your parents and you don't want to be paying rent. So when you are 25 and you start visualizing that, okay, by 35, I want to have a house. Now, how should this house actually look? Maybe top floor of a building, have a penthouse along with it, maybe in a great location, say in somewhere like Bangalore or maybe Gurgaon or wherever. You need to have some sense of what does such a house cost today. And potentially, by taking past data or some inflation numbers, you need to also get a sense of what will such a house cost when you actually turn 35. So what kind of budget would you like to have? Now, we all know that it's not always possible that in a span of 10 years, you're able to collect a few crores or a few lakhs to be able to buy that house. So, but at the same time, it's not a wise financial decision to borrow pretty much everything that you need to buy the house. So we need some sense of what this house costs today. We need some sense of what this house will cost when we actually reach the point of being able to buy it. So that will tell you what kind of money is needed. Now you got to work backwards. Then look at it this way, that I want, say, 5 crores 10 years from now, or let us say put it 15 years from now. So I say that I want 5 crore rupees 15 years from now. And I have a notion that, let's say, equity as an asset class should grow at a rate of 10% or say 12% year on year. In general, we are talking about index or we are talking about some large companies. We are not talking about the funds that I manage or some of my peers manage. We are actually talking about the general index or the general set of equities. So let's say I need 5 crore rupees 15 years from now, and I have a notion or a sense that equity as an asset class should appeal to me appreciate at a rate of 10% year on year. Now, let us say that I am able to save 20,000, given my current salary, given my current set of expenses. Let us say I am able to save 25,000 rupees per month right now, which means that in a year, I will be able to save 3 lakh rupees. Now, it's very simple Excel calculation. In the Excel, Microsoft Excel has these functions which are related to present value or future value. So if you actually go to your Microsoft Excel and you actually draw up a function which says that, okay, if I put 3 lakh rupees every year for the next 15 years, and in the journey, it is going to compound at a rate of 12% year on year, then where will I reach at the end of 15 years? The other thing to keep in mind, importantly, is that your ability to save is not going to be necessarily 20,000 rupees per month or 25,000 rupees per month in perpetuity. Maybe a couple of years down the line, instead of 20,000 per month, you might find yourself in a position to invest, say, 35,000 a month or 40,000 a month or some other number. As you go along, in between, you will have other sources of income. For example, you might liquidate some stock options, or you might actually earn an incentive, or you might earn or you might receive some gifts. So all of this also needs to be bumped into the calculation. But long story short, I think it's very, very important for all of us to do three or four things. One, just like I gave you an example of housing, write down a set of goals. This could be anything. This could be about buying your favorite car. This could be about buying a house. This could be about planning a future for your child and their education. Or this could be just about taking a world tour maybe 5 years down the line, going to your famous or your most favorite exotic vacation destination. So any human being, whichever stage of life we may be, 25, 30, 40, 45, unless and until we have this humongous inheritance whereby, okay, maybe we don't need to think of all these things. But for most of us, we have 3, 4, 5, or maybe 6 different life goals. And each of these life goals is going to come up maybe 3 years down the line, 5 years down the line, 10 years down the line. So there is a timeline at which we would like to achieve certain goals. And each of these goals surely have certain cost calculations which we need to put down. I think that the only way to achieve our life goals is to be able to write them down, and it's to be able to quantify them in terms of what it will take, and then make them into actionable goals. And the only way to make your life goals into actionable goals is, like I said, write them down, calculate the money value of those goals, and then do a back calculation that if I want to reach this, then how much money do I need to save, and at what rate this money needs to grow. Now, why have I given you all this logic and science behind goal-based investing is because in reality, when I meet youngsters or I meet any investors, the way they invest on what I call a cash flow basis. So let us say I get some money today. Let us say this is 30th of April or maybe 31st of January, and I happen to receive a bonus or an incentive from my company. So once I get the money, I kind of go and ask my friend, okay, what do you think I should do? Or I ask my parents, or I ask my friends, or my brother, or my elder sister. I ask one of these guys, or I may ask my chartered accountant. We ask one of these guys that, okay, I have this money. What is a good thing to do nowadays? And what do you think they are going to reply? They are going to reply basis where they come from. Now, let us say I'm in the habit of consulting my neighbor. Every time I have money, I go ask my neighbor, what should I do with this money? So let us say my profile is that I am actually, theoretically, let us say that I am married, I have 2 kids, my parents are dependent on me, and I have a home loan to pay. So that's my life stage. And I'm in the habit of consulting my neighbor, and my neighbor is single. His house is fully paid up because his parents bought it for him. He is obviously not married, he doesn't have kids, and he has no financial responsibilities. So, where do you think his advice will come from? Do you really think that before advising me, he is actually going to put himself into my financial shoes? Obviously, the answer is no. So, he's most likely to say what he did, or he's most likely to say something from the last fancy thing that he read, and his requirements and your requirements obviously don't see eye to eye at all. So it's most important that instead of investing based on, okay, today I have money, what's a great thing to do? Instead of that, if you actually documented your goals, calculated their financial values, and kind of written down a route map that, okay, to be able to achieve this goal in 15 years, I need to be able to invest this much every month. It will grow at this particular rate. This is where I land up in 15 years. And yes, maybe there is going to be a shortfall of a few lakhs, and that will be made up with a home loan or something like that. So if you have all this written down and well planned, then I think, the our usual tendency to react instead of respond, I think that gets put on the back burner, and we start planning things much better for things which are extremely crucial and critical in life. The other thing which I have seen is that when people don't have their goals documented, when people don't have their goals planned or calculated, then they also make another big mistake, which is to make blanket statements like, I always invest in equity because I love taking risk. I never invest in equity because I am risk averse. I put all my money only in the bank. You know what? All these things are not about your choices. There's no room for choices out here. The fact is that if you need to buy a house in the next 10 years and all your calculations show that, okay, you don't want to take more than 50 lakhs loan. So let's say you have to shell out 1 crore yourself. Now, the point is that if you're going to save 20, 30, 40,000 a month, which is going to grow at a rate of 10, 12% a year, and it has to anyhow reach, say, a crore, then you have no choice. You can't say that I'll keep that money in the saving account and at a rate of 3.5%, it's just going to start traveling towards 1 crore. It doesn't happen that way. 20,000 per month, meaning 2,40,000 per year, in 15 years is, say, about 40 lakhs or some such amount of saving. If that has to reach at 1 crore, then please use Microsoft Excel and figure out at what rate it needs to grow. If the answer is that it needs to grow at 10, 12, or 14%, then where is the choice of making statements like, I don't take risk? There's no choice. It has to be invested in equity. It has to be invested very judiciously with the right funds, or by doing your homework and buying the right stocks, or whichever way that you would like to arrive at. So I think that, long story short, uh, we need to stay away from making investment decisions based on some cash flow situations or based on opinions given by friends and family. We need to stay away from, when it comes to investing, we need to stay away from making absolute statements like, I love equities, I don't love equities, I don't take risk, I take risk, I need high return, I need low return. I don't think these are things which are left to choices and opinions. I think these are things which need to be answered very, very scientifically. And I will repeat one thing I said in the beginning, that if we're really serious about our life goals, then they need to be calculated, documented, and they need to be converted into real world money goals. And they need to be actually translated into certain mathematical equations. That if this is the goal, this is how much it needs, this is the rate at which the asset class will grow, this is what I'm able to save every month. So, can it possibly reach there or not? What is the worst outcome when you document all this? Maybe you realize that, okay, one or two goals are not realistic, but yeah, at least you know what it means. And maybe you think that, okay, some of these goals need to be postponed by a couple of years. Maybe there is good news that, yeah, okay, this goal I can do maybe much earlier than what I thought. So, whatever it is, at least we will know where we stand. And if we need to do something about our goals, then first thing, if you want to go, before you start asking for directions, the first thing you need to know is where you are at right now. Because you can't begin any journey without knowing where you want to go, what direction are you headed, but most importantly, you need to know where you stand right now. So that's what I wanted to share with you about goal-based investing. I try to keep it as straightforward as I can, and without getting into too much of jargon and arithmetic. But thank you for listening me out. Sorry for a long-winded monologue, but I'm happy to take any questions.
Great. Thanks, Ashish. Thanks so much for your time on this. And it was really, really insightful. And as usual, a lot of our users have posted comments on YouTube. They've asked a few questions. Questions are really outlandish, like how do I become a mutual fund manager, or how do I know real money? So these questions I wouldn't expect you to answer. But I think the more serious ones are the ones that you have to start answering.
Yep,
Uh,
sure.
yeah, so maybe, I mean, if you can write a book later saying how to become a mutual fund manager, but that's not for this session. So the first question which I want to shoot to you is, um, this person wants to set a goal of 30 lakhs, and his maturity time should be 15 years. I'm guessing there are SIP calculators, but he's asking what should be the SIP amount and which fund do you think he should be in?
Okay, so I think which fund to buy, I will leave it for him to log into Zerodha and figure out. Because
Yeah.
never ask a barber if you need a haircut. So if you tell me which fund to invest in, I'm most likely to tell you Motilal Oswal is God's gift to mankind. But I would not want to give anybody this kind of biased advice. So I'm not the right guy to advise on what kind of fund is good. Our funds are good. I invest only in my funds, but I'm not the right guy to advise. But yes, you're right. There are SIP calculators, and as you'll appreciate, we are live on this particular interaction. So I don't have the luxury of holding my laptop and making calculations. But what I would say is that if you want to reach us, I mean, Microsoft Excel has this very simple function, which is about calculating the future value. If you put in certain installments, and those installments over a certain number of periods are going to compound at a certain rate of interest. So you're going to put installment value, you're going to put number of periods, and you're going to put the rate at which the asset grows. If you put all of that, then the goal in terms of the future value can be easily calculated. At the same time, you're right. Our website has SIP calculators. There are many. You just Google SIP calculator and you'll get, I mean, a plethora of those actually. But yeah, it's
All
great.
right.
I love the question. It's a great way to start. At least I know that people are going to put it into action. Whatever I said.
Yes, yes, absolutely. What you said was really interesting. And another question is, he's saying, it's maybe unrelated to what you've discussed, but he's saying that what if I've invested in a mutual fund and it's losing money, not actually making me money? When is the right time? I mean, I don't think there's ever a right time or the wrong time, but when does it take a call to bite the bullet and exit it?
Very good question. I think it didn't come up in my talk, but clearly, when you are investing in equities, let's take an example that it's spoken a lot of times that okay, last 10 years or last 15 years, the compounded return on equity is more like 15% compounded or 12% compounded. Uh, what one needs to keep in mind is that equity is an asset class wherein if you say 12% compounded, it doesn't come like 12, 12, 12, 12, and 12. The 12% compounded basically comes, if you're sometimes markets are headwinded, companies are producing results, but share prices are not moving in tandem because of multitude of reasons. So when you start by putting 100, it might just happen that first the 100 becomes 85, and then it travels towards 115, and then it travels towards 125, and then somewhere along the way it comes down to 120. So the 12% CAGR, the word CAGR obviously means it's not going to be 12, 12, 12, 12, and 12. It can go all over the place, but eventually it will head towards its destination. Now, when do you bite the bullet? Funds, I think this takes some doing. Either you need an advisor or you need somebody who is used to following funds. But even if you're going to do it yourself, then I think a bit of reading is needed. For example, if you read any of our literature, we clearly communicate what type of stocks we try to buy. We clearly communicate what type of investing philosophy we follow. I think the best identification of if you have to bite the bullet and exit is not just that 100 has become 90, so this guy is doing badly, so I should exit. That's not the point. 100 can become 90, like I already explained. But when 100 becomes 90, when you invested, what language or what thought process was communicated through our websites and our blogs and our brochures? And when 100 becomes 90, what communication are we making? Are we giving some guidance? Are we giving some explanations? Or are we just giving justifications and excuses? What kind of stocks have we bought? Are these fundamentally sound companies? Are we communicating consistently, or are we going all over the place every time inventing a new reason for the decline in values? So I think simplistically put, consistency of language and consistency of content and consistency of the clarity of communication, I think that is something very important. When you find people who are inconsistent, then I think that's when you bite the bullet and review that investment and maybe give it to someone else.
Great. Thank you so much. That was really, really important for even me, actually. So, uh, so assume this is from Rajesh Hegde. If I have a goal of 10 years of around, say, 25 lakhs, and if I invest in equity for the first 8 years, and should I start shifting it to debt to, preserve my capital, or should I continue with equity?
Very good question. I think there is this concept, which is called a glide path. So I think he's absolutely right that if you think you're doing really well and you are likely to achieve your goals, say, you planned in a certain manner, and the first 7 8 years of your journey tells you that yeah, you're going to get there by 10 years. And sometimes what happens is also that just before your goal is being reached, or just before you get closer to your goal, like you rightly asked, last 2 years, and you feel that okay, somewhere the general ethos or the general environment kind of tells you that okay, equities are expensive, the market looks really high, and my goal is just around the corner. I've already pretty much made most of what I wanted to make, so why expose myself to the downside in the last 2 years? I think that's a very wise thing to keep in mind, that when you're just around your goal, I mean, 1 or 2 years is a short time frame to gauge anything in equity. So if you have 10 years in mind, and by the time you are 7.5, 8 or 8.5 years through the journey, and you think that, okay, markets are looking expensive, I've already got what I had to, so definitely you should start moving and tapering your equity exposure. If you already achieve your goals, by all means, just remove the money and sit in the liquid fund or in the bank account. But yes, I completely back this thought process that if you're close to your goals, then don't expose yourself to unnecessary risk.
Thanks. So, like goal-based investing, user has to think about his priorities. Now,
Yeah.
the thing about these priorities is that how does an investor decide what are his priorities? How does he assess his priorities?
Okay. I think so. Two or three things. One is that, first of all, there is no harm in priorities changing, or there is nothing wrong about not knowing your priorities. But if you don't have priorities, just write goal X, goal Y, goal Z, or just write goal A, goal B, goal C. And then as you get along, as you get clarity in life, then instead of A, you can write probably marriage, or instead of B, you can probably write that I want to, have my own startup and I need initial seed capital. So I don't think it's important to know all your priorities. Even if you don't know your priorities, just write A, B, C, X, Y, Z, and think of what potentially might appeal to you. The other thing is that never ask a financial planner for your priorities, of course. Never ask a fund manager for your priorities. But I think if you don't have priorities, then just start saving either which way. I think priorities will come as you go along. But definitely don't blow up your money. Let's not be, keeping money in a way that we are absolutely purposeless. Eventually, the purpose will come along, and there's no harm in having some money in the bank by the time the purpose comes along.
Absolutely right. I concur with that. I mean, it's important for you to start, securing your future very early, as opposed to, I mean, sooner is better. And another question which has come up is, uh, so when I'm setting my financial goal, should I really worry about the CAGR of a fund, or should I just pick a bunch of funds and get started? What's easier?
Yeah, so what is most important is what is my goal and what do I need to do to be able to get there. And all these funds are actually, we people like me or people like us, people who are part of my industry, we have this huge sense of self-importance actually, and the advertising we do and sometimes the communication that we make kind of tries to hijack the agenda by telling people that okay, this fund is great, that fund is not great, and all these kind of things you read. In reality, these are all just via media. People like us are just there to be the medium whereby you will be able to achieve your goals. And we try to do our best to manage money in a way that we, over the long term, keep it safe and at the same time try to grow it at a reasonable rate, despite, of course, the ups and downs that go with equities. But most importantly, I think your goals are more important. What you need to do to get there is most important. And then as far as funds are concerned, like I said, they are just the medium. There is enough and more research which is available. I'm sure on Zerodha platform, people will be able to find out which funds are performing well, which ones are not performing well. And it's not just about the immediate past performance. It is also about the kind of investing philosophy that is communicated. It's about the investing rationale that is communicated. It's about the past consistency, and consistency not in just numbers, consistency in terms of the approach. I think there are many of these things which need to be seen. Which fund to invest in, I think that's the last decision to make. What are my goals? What do I need to get there? I think that's the first decision to make.
All right, all right. So another thing is that a lot of people who have gotten to a certain age, maybe in their late 40s or early 50s, they sometimes feel they've missed the bus, because everyone's talking about start investing in mutual funds early and secure your future. So these guys are running towards FDs, or they're trying to buy property and all. So how do we encourage people who are in the later stage of their careers to still bet on mutual funds as opposed to just going in for something like a property or a fixed deposit?
Yeah, so whatever I said, I mean, we have this sense of a digital audience being 25, 30, 35, maybe slightly cliched, maybe slightly caricaturish. But whatever I said doesn't mean that because I gave examples of 25, 30, or 35-year-olds, just because I gave those examples, it doesn't mean that what I said doesn't apply to somebody who's 40 or 45. In fact, I even tell people who are retiring, for example, people retire in our country around 60 or 65 or 62. And they also ask me these questions that should they just park money in a fixed deposit and they can't take risks and all those kind of things. Now, two clarifications. Start early doesn't mean start at 21. Start early means early relative to wherever you are. I mean, if I'm at a certain age on this particular day at this time, early means right now. So early doesn't have a definition. Early is a relative term. The moment you realize is early enough. And as far as the path for the future, I mean, even if you're 65, I don't think you're going to be planning your life for 68 or 67. I mean, even if you're 65, you got to plan for 95 or 100 or 105, right? People live a 90, people live a 95, and I mean, we should hope that all of us live 100. So even if you're 40 or 45, that's half your life, and you need your money to grow. And if you become defensive at 45, and put all your money into safe products, and your money doesn't grow, then what inheritance will you leave for the next generation? And
Absolutely.
yeah, and how are you going to actually live the best standard of living when you are 75 or 80? Medical costs are not coming down. Aspirations are definitely not coming down. So I think everybody needs their money to grow. And like I said, early doesn't have any definition. Early means right now.
Great, great. Thank you so much, Ashish. I had a real pleasure listening and learning from you, and I hope our users also had the same pleasure. And well, I think we'll have to end the session now. Thanks for your time, and we'll probably have a Ask Me Anything session on trading Q&A in the future. And there, people will write questions, and if you have the time and if you could answer them, they'll stay on print forever. So anybody, future, like 5 years from now, 2 years from now, can read them and continue to learn without having to, be listening to you. I hope you'll be available for that.
Yeah, my pleasure. Thank you for having me.
Sure. Have a nice day. Bye bye.